Christine Lagarde just did something that violates 70 years of central banking orthodoxy. At 3:47 AM Frankfurt time, the European Central Bank deployed 480 tons of silver reserves in a desperate attempt to save the euro. Not gold, not bonds, not currency swaps. Silver. And if this doesn't work, the European monetary system collapses in weeks. What I'm about to reveal isn't economic theory or monetary policy analysis. This is about the moment when the world's second largest central bank abandoned everything they claimed to believe about modern currency systems and resorted to precious metals, intervention that proves the euro is dying faster than anyone publicly admits. The emergency began 18 hours ago, not with a press release or scheduled announcement, with algorithm-triggered sell orders that no central bank policy could stop, euro-dollar exchange rate dropping, European government bond yields spiking, banking sector stocks across 17 countries crashing. The mathematical models that keep the eurozone stable were breaking down in real time. And Christine Lagarde had two choices: watch the euro collapse or activate a protocol that was never supposed to exist. She chose Silver Firewall. The leaked ECB internal communications reveal the scope of the crisis that forced this unprecedented intervention. Communications that show European central banking leadership in full panic mode, discussing options that would have been unthinkable 6 months ago. 480 tons of physical silver, released from strategic ECB reserves that most people didn't know existed, sold into global markets during Asian trading hours when European oversight was minimal, all to create artificial support for a currency that mathematical models showed was entering terminal decline. This wasn't monetary policy. This was a desperate attempt to prevent the collapse of the European Union through precious metals manipulation. Let me show you exactly what happened, why the ECB was forced to violate its own founding principles, and what this means for anyone holding euros, European assets, or faith in modern central banking. The crisis started with European energy costs, natural gas prices that never recovered from geopolitical disruptions, electricity costs that made European manufacturing uncompetitive globally, industrial energy bills that forced factory closures across Germany, France, and Italy. Higher energy costs created inflation that European central bank interest rate policies couldn't control, not demand-driven inflation that responds to monetary tightening. Supply-side inflation caused by structural energy price increases, the ECB raised interest rates anyway, because that's what central banking orthodoxy demanded. Fight inflation with higher rates regardless of the underlying causes. Higher interest rates made European government debt more expensive to service. Countries like Italy and Spain that were already running budget deficits suddenly faced borrowing costs that made their debt burdens mathematically unsustainable. Bond markets started pricing in sovereign debt defaults. Not immediately, but inevitable, given the trajectory of debt service costs versus government revenues. Higher borrowing costs for European governments meant reduced public spending. Reduced public spending created economic contraction. Economic contraction reduced tax revenues. Reduced tax revenues made government debt problems even worse. A feedback loop that monetary policy couldn't break. Higher rates made inflation worse by increasing energy and housing costs. Lower rates would have made debt problems worse by reducing confidence in European fiscal sustainability. The ECB was trapped between inflationary pressures and debt crises with no conventional policy tools that addressed both problems simultaneously. European banks were the first casualties. They held massive quantities of European government bonds that were losing value as interest rates rose. Their capital reserves were eroding as bond portfolios showed larger losses every month. Banking sector stress tests revealed that 17 major European banks would face capital shortfalls if bond losses continued at current rates. Not small shortfalls. Capital requirements that would force emergency recapitalization or closure. European governments couldn't recapitalize banks because they were facing their own fiscal crises. The entities that needed rescue couldn't rescue each other. The mathematics were clear and terrifying. European banking system collapsed within 90 days unless something fundamentally changed about market confidence in European asset values. That's when Christine Lagarde authorized Silver Firewall activation. The protocol was developed after the 2008 financial crisis, but never used. Emergency procedures for systematic banking crisis that conventional monetary policy couldn't address. Precious metals intervention designed to restore confidence when currency values were under existential threat. Silver Firewall gives the ECB authority to deploy strategic precious metals reserves to support euro exchange rates during crisis conditions, not through normal market operations. Through direct metals, sales that create artificial demand for euros. The mechanism works by forcing silver buyers to purchase euros in order to buy ECB silver. Large-scale silver sales create large-scale euro buying. Euro buying supports exchange rates, even when fundamental economic conditions suggest euro weakness. It's currency manipulation using precious metals as the lever. But Silver Firewall comes with a cost that reveals the desperation behind its activation. The ECB is liquidating real assets to support a fiat currency. They're trading tangible value for artificial exchange rate stability. 480 tons of silver equals approximately $540 million at current market prices. The ECB just spent $500 million in real assets to buy temporary euro strength. That math only makes sense if euro collapse costs exceed $540 million, which means the ECB's internal models show euro failure creating economic losses measured in hundreds of billions or trillions of euros. Silver Firewall isn't just monetary policy. It's an admission that conventional central banking has failed and desperate measures are required to prevent currency system collapse. The operation began at exactly 3:47 AM Frankfurt time. Coordinated silver sales through London Metal Exchange, Shanghai Futures Exchange, and COMEX simultaneously. Volumes large enough to move global silver prices while creating massive demand for euros. The silver was sold at slight discounts to market prices to ensure immediate execution. Speed was more important than optimal pricing. The ECB needed euro buying pressure immediately, not maximum revenue from silver sales. Market impact was immediate. Euro-dollar exchange rate stopped falling and began recovering within 30 minutes of the first silver sales. European bank stocks stabilized as currency support reduced concerns about sovereign debt crises. But the relief is temporary, because Silver Firewall addresses symptoms rather than causes of European economic problems. Energy costs are still elevated. Government debt burdens are still unsustainable. Banking sector capital problems are still growing. European manufacturing competitiveness is still compromised by structural disadvantages. The ECB bought time, not solutions. And the time they bought is expensive. 480 tons of silver for maybe 6 weeks of currency stability. What happens when Silver Firewall reserves are exhausted? What happens when markets realize that ECB silver sales were desperate measures rather than confidence-building strength? The leaked ECB communications reveal that Silver Firewall is phase 1 of a broader precious metals intervention strategy. Phase 2 involves gold sales. Phase 3 involves coordinated precious metals operations with other central banks. But each phase requires liquidating real assets to support fiat currency values. The ECB is systematically converting tangible wealth into artificial currency strength. This strategy works only as long as precious metals reserves last. European central bank holdings include approximately 12,000 tons of gold and 1,200 tons of silver. At current deployment rates, those reserves provide 18 to 24 months of currency support. After that, the ECB has no more real assets to liquidate for artificial currency strength. European monetary system survival becomes dependent on fundamental economic improvements that show no signs of materializing. Silver Firewall reveals that European central banking leadership privately acknowledges the euro's terminal condition. You don't deploy emergency precious metals protocols unless conventional monetary policy has completely failed. The most disturbing aspect of Silver Firewall isn't the precious metals sales. It's what the operation reveals about ECB confidence in their own currency system. Central banks are supposed to accumulate precious metals reserves as stability anchors for fiat currency systems. The ECB is liquidating precious metals reserves to prevent fiat currency collapse. They're consuming the foundation of monetary stability to maintain the appearance of monetary stability, eating their seed corn to survive the current harvest. This approach can work short-term, but guarantees long-term systemic failure. Every ounce of silver sold is an ounce less available for future currency crises. Each precious metals intervention makes the ECB less capable of responding to the next crisis. Meanwhile, other central banks are watching European precious metals liquidation with growing concern. Not because they support the euro, but because ECB silver sales distort global precious metals, markets that everyone else depends on. The Bank of Japan holds silver reserves for monetary stability. ECB silver sales drive down prices and reduce the value of Japanese monetary reserves. European crisis response creates Japanese monetary problems. The Federal Reserve maintains precious metals reserves as last resort currency backstops. ECB silver liquidation establishes precedent for central bank precious metal sales that could trigger competitive devaluation cycles. If Europe sells silver to support euros, what prevents Japan from selling silver to support yen? What stops America from selling gold to support dollars? Silver Firewall could trigger global central bank precious metals liquidation as each country tries to maintain relative currency strength through real asset sales. The end result would be central banks worldwide consuming the precious metals reserves that provide ultimate backing for all fiat currency systems. But the immediate market effects of Silver Firewall are already reshaping global silver dynamics in ways that most investors don't understand. 480 tons of ECB silver flooding markets creates artificial supply that depresses prices and disrupts normal supply-demand relationships. Mining companies see reduced revenues from lower prices caused by central bank sales, rather than market fundamentals. Industrial silver consumers benefit from lower prices, but face supply uncertainty as central bank intervention makes future silver availability unpredictable. Silver investors discover that precious metals markets are subject to central bank manipulation that can override investment fundamentals whenever monetary authorities decide currency support requires precious metals liquidation. The silver market is no longer determined by industrial demand and mining supply. It's determined by central bank crisis management and currency intervention priorities. ECB silver sales establish precedent for precious metals markets being subordinate to fiat currency stability, rather than serving as alternatives to fiat currency systems. But Silver Firewall also reveals the fundamental weakness of fiat currency systems that rely on precious metals backing only during crisis conditions. If silver reserves are necessary to save the euro, why aren't silver reserves part of normal euro monetary policy? If precious metals provide stability during crisis, why don't precious metals provide stability during normal conditions? The ECB's actions prove that fiat currencies require precious metal support for survival, while simultaneously demonstrating that fiat currency crises consume the precious metals reserves that provide that support. It's a system designed to fail. Currencies, backed by nothing during good times, become currencies backed by depleting precious metals reserves during bad times. Eventually, the precious metals reserves are exhausted and the fiat currencies collapse anyway. The only question is whether collapse happens sooner, through immediate currency failure, or later through gradual precious metals liquidation. Silver Firewall chooses later collapse through current precious metals liquidation. European citizens are discovering that their currency depends on real assets that their central bank is selling to maintain artificial currency values. The euro's strength comes from liquidating the tangible wealth that could protect Europeans from euro weakness. It's the monetary equivalent of burning furniture to heat a house. Temporary warmth achieved by consuming assets needed for long-term survival. And the precedent establishes dangerous expectations for future crisis management. Markets now know that the ECB will liquidate precious metals to support euro exchange rates. This knowledge creates moral hazard where currency speculation becomes profitable because speculators know central banks will intervene with real asset sales to prevent currency collapse. Silver Firewall makes currency attacks more likely by demonstrating that successful attacks trigger precious metals liquidation that benefits currency speculators at the expense of central bank reserves. The ECB created incentives for financial warfare against European monetary stability. But the most chilling aspect of Silver Firewall is what it suggests about ECB leadership in its private assessment of European economic prospects. You don't activate never-used emergency protocols unless you believe conventional solutions are impossible. You don't liquidate strategic reserves unless you believe normal policy tools have permanently failed. Christine Lagarde authorized Silver Firewall because European Central Bank leadership privately acknowledges that European monetary system survival requires desperate measures that violate 7 decades of central banking orthodoxy. The euro is dying. Silver Firewall is life support that provides temporary stability by consuming the assets that could provide permanent stability. European monetary authorities chose short-term currency support over long-term monetary system survival. The leaked ECB communications contain one final detail that should terrify anyone holding European assets. Silver Firewall authorization includes provisions for Phase 4 precious metals liquidation involving coordination with allied central banks for systematic precious metals deployment. Phase 4 means the ECB expects Silver Firewall to fail. They're already planning coordinated precious metals intervention with other central banks when European crisis spreads beyond ECB capability to manage alone. The most sophisticated monetary policymakers in Europe are planning for European monetary system failure that requires international precious metals intervention to prevent global monetary system collapse. Silver Firewall isn't just about saving the euro. It's about preventing European monetary failure from triggering worldwide currency system breakdowns that require global central bank coordination. European crisis is becoming global crisis, and the solution is consuming precious metals reserves that provide stability for all fiat currency systems. 480 tons of silver bought the ECB maybe 6 weeks of euro stability. The question is what they'll liquidate when those 6 weeks end. The answer is in the leaked communications. Phase 2, gold sales. Phase 3, coordinated intervention. Phase 4, systematic precious metals liquidation. The European Central Bank is systematically converting Europe's monetary foundation into temporary currency stability. When the precious metals are gone, the euro dies. And everyone holding euros discovers that their currency was backed by assets their central bank sold to maintain currency values. Silver Firewall reveals that the euro's strength comes from consuming the wealth that euro holders thought supported their currency. It's monetary cannibalism, and it just began.